On March 10, 2023, $42 billion vanished from Silicon Valley Bank in a single day. The collapse of Silicon Valley Bank, or SVB, is a stark reminder of how quickly fortunes can change in the financial world. Founded in 1983 by Bill Biggerstaff and Robert Medeiros, SVB grew from a small regional bank into a financial powerhouse, managing $209 billion in assets and serving as the primary banker for nearly half of all U.S. venture-backed startups. Its prestigious clientele included names like Airbnb, Pinterest, and Stripe. But in just 48 hours, this financial titan fell, marking the third largest bank failure in U.S. history. The crisis began to take shape as the tech sector faced a steep downturn in 2022, compounded by soaring interest rates. These factors set off a cascade of events that would ultimately lead to SVB's downfall. On March 8, 2023, SVB announced a staggering $1.8 billion loss from asset sales designed to shore up its balance sheet. The bank had invested heavily in long-term government securities, whose value plummeted as the Federal Reserve raised interest rates to combat inflation. The news sent shockwaves through the venture capital community, which had long relied on SVB's services as a financial bedrock. Venture capitalists, who once championed the bank, now advised their portfolio companies to withdraw funds immediately. The looming threat of insolvency was too great to ignore. Rising interest rates had been a ticking time bomb for SVB. CEO Greg W. Becker, who had been at the helm since 2011, focused on short-term profits, yet failed to hedge against these financial risks. The bank's strategy, which once seemed like a masterstroke, now appeared dangerously flawed. As SVB's stability wavered, depositor confidence crumbled. On March 9, 2023, withdrawal requests began flooding in at an alarming rate. It was a modern-day bank run, accelerated by the digital age where transactions could be executed with a few taps on a smartphone. By March 10th, the situation reached a boiling point. Depositors demanded their money back with urgency and fear. Over $40 billion was withdrawn within 24 hours, an unprecedented event in U.S. banking history. For comparison, during the infamous 2008 financial crisis, Washington Mutual faced withdrawals of $16.7 billion over 10 days before its collapse, a fraction of SVB's shortfall. Federal regulators moved swiftly to contain the fallout. The FDIC took control, but the damage was done. The rapidity of the collapse stunned the financial world and left a gaping hole in the ecosystem it once supported. The human cost was immense. Over 17,000 customers, including startups and tech firms, were left in limbo, scrambling to access their funds. The financial impact rippled across the tech sector, triggering a steep sell-off in equities and leading to significant losses. For many startups reliant on SVB, the collapse meant operational challenges, layoffs, and halted projects. Co-founders of fledgling companies sat in disbelief, staring at dwindling bank balances, wondering how to make payroll, pay vendors, or continue operations. The psychological impact on the entrepreneurs and employees was profound, as many faced the possibility of seeing their dreams vanish overnight. Amid the chaos, the question remained, how did this happen so quickly? The root cause lay in the bank's flawed risk management. SVB prioritized short-term gains without adequately preparing for rising interest rates. The bank's leadership had underestimated the speed and scale at which interest rate hikes would impact their long-term investments. As the tech sector faltered, depositor confidence shattered, triggering a crisis that spiraled out of control. Analysts pointed to the lack of diversification in SVB's portfolio and its over-reliance on the tech industry as critical vulnerabilities. The aftermath of SVB's collapse serves as a cautionary tale about the fragility of depositor confidence and the critical importance of sound risk management. The very venture capitalists who once hailed SVB as a trusted partner became catalysts for its downfall. "We need to withdraw our funds now," became the rallying cry that sealed SVB's fate. The speed at which information spread in the digital age played a significant role in amplifying fears and accelerating the bank run. Social media platforms and instant messaging apps became conduits for panic, as entrepreneurs and investors alike sought to protect their assets. As the dust settles, the impact on the tech ecosystem will be felt for years. The collapse of SVB prompts a re-evaluation of banking practices and regulatory oversight in the volatile world of venture capital. It's a stark reminder that in financial markets, trust is fragile, and fortunes can change in an instant. The Federal Reserve and other regulatory bodies have since launched investigations into the collapse, aiming to understand the systemic risks and prevent future occurrences. Policymakers are now grappling with the challenge of crafting regulations that strike a balance between innovation and stability. In the wake of SVB's failure, a sense of vulnerability pervades the tech industry, as startups reassess their banking relationships and financial strategies. Entrepreneurs are more cautious, diversifying their banking partners and seeking more transparency from financial institutions. The lessons learned from SVB's collapse underscore the importance of resilience and adaptability in an ever-changing financial landscape. As the tech world looks to the future, the story of Silicon Valley Bank will serve as a poignant reminder of both the opportunities and perils that accompany rapid growth and unbridled ambition.